Good day, fellow investors. Yesterday we discussed inflation, how the solution when it comes to investing with inflation is investing in great businesses. And this weekend I wanted to treat myself with doing what I love the most, which is looking at businesses. And to do that, I'll look, as Buffett says, when you're looking at businesses, start with the A's, and I'll look at each business of the Dow Jones Index. So you'll have timestamps in the description below. You also should have them here on the video to go to the business that interests you most. We're going to do a quick comparative valuation for each business. I have used data from Morningstar, from Value Line. These are all big businesses, so pretty much everything is known about them, which then boils down to valuation, future growth, and looking at what the market doesn't see, but you always start with valuation, dividends, and also it depends on you whether you are happy or not with the current situation. As always, we'll put everything that we found in our valuation table. If you click on any on these companies, it will bring you to the valuation scenarios, to the intrinsic value for a 10% long-term return. My goal here is to just collect as many businesses as possible, have the 10% return intrinsic value calculated compared to the market price, and then over the long term, over the following decades, to just follow them, see the quality of the business, adjust the valuation, and see when some of these, in this case great businesses, are a strong buy or a good buy in comparison to other companies. We're going to take a look at the key factors, key financials for each company downloaded from Morningstar, and I really hope you enjoyed this video. If you do, if you get value from this video, all I ask is for clicking that like button. Let's start with the Dow Jones stocks. Of course, if you look at the Dow Jones now at 34,000 points, it's really in an exuberant place now, but we invest in businesses, so it's always good to look at the businesses. Despite the fact that the Dow Jones is up, what is this? 6 times almost over the last 12 years, which is really incredible. I remember here the Dow breaking 10,000 and everyone considered it overvalued. Now we are 3 times this, which is really remarkable and an indication of how stock markets work. Now we're looking at inflation likely ahead. Everyone wants protection, everyone wants safety, and interest rates are at 0, so the Dow might not look that bad at all. Nevertheless, it's made of businesses, so we look at the valuations and see what company is the best to follow, and then you also compare to all the others that we did, and then we'll see when or what is a buy. Let's start with 3M. 3M is a great business, definitely. I made a video, I think a year ago on it, discussing the valuation there and discussing whether 3M is a stock to buy. That is up to you, because it is a pretty stable business. It has 180,000, 120,000 patents. It makes all those specialty chemicals alongside its own brands that are really needed for a lot of producers, and they really can't change supplier like this. So it has a wide moat, it's a stable business, and it all depends on the financials and long-term outlook compared to the price. If we take a look at the dividend yield, I've taken forward prices, so what is expected in 2021 from Morningstar, and also Value Line for some forward valuations, and forward yield 3%. The price earnings ratio is around 20, so the cash flow per share is strong. If we take a look at long-term financials, we can see that revenue growth has actually been stagnating for the last 7-8 years. However, the margins are stable there. Operating income also stagnating alongside revenue. Margins stable. Earnings per share going a little bit up lately as the company has done a lot of buybacks, so they have done buybacks, doing buybacks, lowering the number of shares, increases earnings per share and increases the dividends per share. However, this is slow dividend growth ahead. There are some legal issues, there are always issues with these big businesses, but we can put this into a valuation. These analysts expect 8% growth from 3M, so if we put that into our table, then I've started with the dividends, and if we expect 7% dividend growth over the next 5 years, 3% later, with a 10% discount rate and a 3.3% expected dividend yield in the future, then the intrinsic value is 158. In a better scenario, we are much higher with higher dividends growth. Worst case scenario, it is much lower. If we compare the intrinsic value we derived with the table here, then 3M is severely overvalued for a 10% return. However, you can always see, okay, where we are for a fair value, 200 is the stock price. If we go back here and we adjust the discount rate, and let's say we put 7 here, that's it. So 3M likely will deliver a 7% return over the next years if everything is as is. So this is not bad, especially not for a great business. So you have to see how this 7% returns fit you. Of course, the return was much higher a year ago, also when I did my video on it, but there will be ups and downs, and you have to see, okay, at what return I'm buying 3M and all the other companies here. So if it is 8%, then you have a strong buy here. This is now up, can be very volatile, and you can see here over history, it's not unusual for these companies to fall also 50% or to have long periods of stagnation. So again, one to follow, it's definitely a good business, and you have to see at what price it fits your portfolio. Next company, American Express, Warren Buffett company. He has, I think, 18% of American Express, so it's a big stake for such a company and also for Buffett. So let's see what Buffett owns. The forward dividend yield is very low. The price earnings ratio is in line with 3M that we saw. It's a financial, so cash flows are not really shown by the data providers that I used. EPS 6.75, dividends per share 1.8, and expected growth 5%. If we look at revenues, slow growth, COVID, let's say decline in revenues that is expected to bounce back. Earnings have also been volatile. It has also been a volatile history for American Express, but they have been increasing those dividends steadily. What is this? 5% per year. Doing big buybacks, decreased about 30% the number of stocks over the last 10 years. And you have to see here the power of buybacks. What are those buybacks doing? Look at the number of shares on Berkshire's stock portfolio, 151,610,700, and they own 18.8% of American Express. It cost $1.2 billion to buy it because I think Buffett bought in 1994, but let's compare this to 10 years ago. So 2010 Berkshire portfolio, same number of shares, but he owned just 12.6% of the company. Now it is 18.8% of the company. So thanks to the buybacks, Warren Buffett increased his ownership by 50% over 10 years. Warren Buffett, I think, bought here in 1997, so he did really well. If he would sell now, there would be a big tax bill for him. So here's happy owning for more share in the company and for the dividends. Of course, even Buffett and Munger say that American Express will not lead to the historical returns they achieved now, that it will be much lower, much slower. So that's also something we have to keep in mind with American Express. I have done a valuation based on dividends with 5% growth with a terminal multiple of 30, and the value is very low when it comes to American Express and comparing it to the current stock price. So really extremely overvalued for a 10% return. You see here the ratio is much better with 3M. So very interesting company, but really richly valued now. As said, also Buffett and Munger said the future will be more difficult for American Express. So let's keep it there and look for other businesses to put our money to work. If we are back to 1997 situations, or find different businesses that are in a situation where American Express was in 1997, then we might take a deeper look. Next one, AMGN. We did some pharma stocks a while as Buffett has opened a few positions there, and pharma is relatively cheaper than others. We already see the price-earnings ratio at 15. The dividend yield is already at 2.75 compared to American Express, but this is always a pharma business, so you have to look at patents expiring, growth, cash flows, the costs, litigation, and a lot of things that are usually what characterizes a pharma business. Let's check. Expected growth is not much, and then it's always volatile, and that is also reflected in the stock price. If we take a look at stock prices, you can always see these ups and downs constantly as the sentiment changes. So especially in the last 10 years, healthcare stocks did really well, but you can see here also such exuberant times followed by decades of really bad performance. So we have to see whether this exuberant performance will continue with pharma stocks, or just wait for decades of nothing where nobody wants to look at pharma stocks like it was the case in the early 2010s. Now everyone is interested in them, so that's also something to watch for. If we look at AMGN, the numbers are not really stellar, slow growth here, so net income also stable. The dividends have been going up and up, which is always positive, but the cash flow is also stable, so we have to see for how long are they going to increase those dividends without having to increase earnings. In our valuation table, if we put in the dividends, I have put 5% dividend growth, terminal multiple 5% yield, which is, let's say, conservative, and less conservative in the best case scenario, more conservative in the worst case scenario with no growth. And if we put that into our valuation table, where is AMGN here? So we have, again, better than American Express, but still, let's say, overvalued for a 5-6% long-term return. So pharma stocks, perhaps a little bit overvalued now, and we'll follow and see over time. Next business, Apple, a business that I have been following now for more than 5 years, a business that I have been bullish in 2016, also long in 2016, stupidly sold too early, or did good with the money that I sold still, but that's a different story. Let's take a look at what Apple is now and what it will likely deliver in the long term. So the forward dividend yield is very low. They're extremely focused on buybacks, but the price-earnings ratio is a little bit pricey at 30. Earnings per share, cash flows really good per share, and as we said, low dividends. But expected growth ahead is significant. If we look at the numbers, they have caught up again with growth, especially focusing on those services, and then you never know whether they'll come up with a new great product. The number of shares is going down significantly. However, the higher is the stock price, the less efficient are those buybacks. So it is one thing doing those buybacks when you have a price-earnings ratio of 10, like it was the case in 2016, and now with a price-earnings ratio above 30. So the difference is staggering, and also the contribution to shareholders is also significantly different. I have already discussed Apple, that explains the high valuation market risk. All this video that I have discussed some stocks will be in the links in the description below, video by video, so you might want to enjoy them for a deeper analysis on specific stocks that you are interested. Here is my Apple analysis. If we take a look at it, and I have put cash flows here, I didn't take into account the dividends. So let's say they do buybacks, and those buybacks increase the cash flows by 8%. Perhaps even better to go here with the stock price. So cash flows per share that are, what are we, 5.25. We'll do that in a sec. So 5.25. And then 8% growth of cash flows, 20 terminal multiple for the cash flows, which we are higher already, but let's be conservative. And then we have a price of 80. With a 30 terminal multiple and even faster cash flow growth, 145, and cash flows with negative terminal multiples of 15, then we are much, much lower. Some price 87. Let me just adjust here the market cap that I usually have. So 87, this equals, did I put Apple here? I think I did the stock price, yes. And you can see here how Apple still gives a 6-7% return, which is in line with 3M, and also with the quality of Apple. It's not that exuberant compared to American Express that we have seen there. So that's why also Buffett is keeping it, and perhaps why he is happy with the buybacks. For me, a little bit too pricey, because I'm waiting for those iPhone cycles for the time when Apple will be regarded as slow growing, etc., like it was in 2016. Perhaps it will be again in 2026. If it is here on the table, then I'll watch the valuations and see. Alright, Boeing is a very, very interesting story. I made a video on it before the Boeing crashes and airplane issues and before the corona crisis, and I was negative on it because it was too exuberantly priced for me, because Boeing had a great decade up till now, and now it was a mess. Now things are improving, and it is expected that all the bad is now in the rear view mirror, and with the booming of the economy, with back to flight and COVID going away, that Boeing will resume its previous glory. If we take a look at the previous glory, you see here really good revenue growth up to 2018, amazing earnings per share growth, huge dividend growth, and that is also what pushed the stock price higher, alongside amazing buybacks. Then the buybacks stopped with all the issues, with the plane crashes, with COVID now, big losses of 20 billion in losses, $20 per share, but this is expected to rebound. And if we look already at the forward measures, that's why I take the forward measures, forward dividend yield 3%, price earnings ratio of 20, good cash flows per share, good earnings per share, and expected growth forward 8%. Putting this into a valuation perspective, I have been a little bit more conservative with the dividends, having them starting again in 2024. So that's a conservative example. Terminal multiple, I still don't get to a very, very high intrinsic value, especially with all the risks. So, of course, there is Boeing, it's Boeing, but I'm a little bit more conservative here. So also when I compare it, it's among the lower end of the Dow Jones companies. You have to see how it fits you. Let's go to, what do we have? Caterpillar. Let's first make a valuation. Again, dividends, I have taken the dividend, I have taken 5% growth. Keep in mind it's a cyclical, so it will always have ups and downs, and the intrinsic value for me is 91 for Caterpillar. Comparing that to the stock price, we are extremely overvalued, 228. As said, it is a big cyclical, so it was much cheaper just a year ago. Now it has boomed on these infrastructure plans, but look at how cheap the stock was here in 2016, 60, now we are at 230, so I think this will come down crashing in the next downturn, which is normal for these companies, and then it will be the time to look at Caterpillar. The best time to look at these companies is when the dividend yield is none, when the price-earnings ratio is non-existing, when these numbers are very bad, because then you catch the upturn in the cycle, not the possible downturn. And how bad it can get, you can see here from 65 billion in sales in the commodity booms, going down to 38, then again booming, then again down, and now it is expected again to boom. But these are big swings. Of course, the company will try to do anything, but keep in mind the cyclicality and play it as a cyclical. Chevron, the oil company, we have recently also made a video, Chevron with Lukoil. I remind you, all the links to the videos I mentioned will be in the description below. So oil companies, oil prices are high now, the stock price has followed. So really rebounded since 2020, but not that much, not up above previous highs, and we can see how oil stocks didn't really do well over the last years. Good dividends, but not that big, as demand for oil is expected to decline. And it is then a dividend play. We see high dividend yields, higher than we have discussed up till now in this overview. And if we look at Chevron that I already did a month ago, then I've taken the dividends in billions, 3% growth rate, because I don't see how they will pay more without something crazy happening. So on an average oil stocks situation on supply and demand, we have 157 as a price. If we compare that to the current price, let's say for a 10% return, we are overvalued, so we are there at a 5–6% return. So the most you can expect from Chevron is actually the dividend. And then the question is, how will the oil environment look 5–10 years down the road? For now, the estimations are negative. Big American oil companies are pushing for oil stability, so that's in their plans. They expected oil growth 2 years ago of 3% per year, demand for oil. So a little bit tricky. I compared Chevron to Lukoil, which is the Russian, let's say, counterpart, and it's much cheaper just because it is in Russia. The products are the same there, the refineries, the everything. So you might want to see whether you are a relative investor focusing on the ups and downs of the stock, or absolute focusing on their business returns. Check that video out for more information. Cisco is a company that I actually own in the large portfolio on my research platform. I have bought it a while ago to learn about the business, and because I expected that the stock will go up, so I have a margin of learning safety, as I call it. Let's see the numbers. The dividend yield is still okay. Forward price-earnings ratio relatively low compared to other companies. Cash flows per share good. Dividends 50%, a little bit 40% payout. Growth there, 5G, all the things that internet data that Cisco is providing for. And I have put here dividend valuation, 6% dividend growth, 4% expected dividend yield. And when we see the valuations, I am here somewhere at 35, 46, 34, with a little bit more exuberant and the current dividend yield terminal multiple. So not really cheap, but also not really expensive compared to others. Good business, did really well over the long term, but it has these exuberant spikes where the market is really exuberant, then very negative downturns, spikes, and here we have seen now since the last, I think I bought here somewhere, so we are going up as the market is getting more positive. So it's a relatively undervalued stock compared to others in the Dow Jones or others in good markets. So you can see here the ratio is the highest apart from 3M that we have discussed here. So a great company to keep watching, to keep following, and we'll see how it ends. I have this in my 20 position portfolio. For now it is on the expensive side, so if I find something better, then I might kick it out or just sell the investment to put it into something else and keep the profits in the large portfolio forever, just to keep an eye on the company and watch these long-term cycles, as we have seen with the stock price. Coca-Cola, Warren Buffett's darling, bought 1 billion of shares in 1988 and enjoyed dividends ever since, and now he's enjoying, I think, a 60–70% dividend yield on cost that he reinvests and allows for compounding. When we come to the numbers, the dividend yield is good, the price-earnings ratio is average, the expected growth globally 5%. There will be an IPO likely of the Coca-Cola Beverages Africa, so that's something to watch and follow if you're looking for exposure to Africa, which is usually something difficult to get. If we look at the position, Warren Buffett has 8.6% of the company, bought for 1.3 billion, so he has 10x that, not including the dividends. There is slow and steady dividend growth, not really stellar, just slow. The cash flows are also relatively stable. They're declining sales as they are divesting and doing different deals, going for better deals with suppliers and bottlers. And from a valuation perspective, for a 10% return, keep in mind, with growth and a conservative terminal multiple, we are at a price of between 30 and 45. From that perspective, for a 10% return, of course, this is overvalued, but you never know. The stock has been lower, has been trading in relation to 10% return just a year ago, just 2 years ago, so it might always come back there. So if you're interested in a business like this, then this is a watch, and then you see when the price hits your expected return, you can play around with this. Then you can see, okay, at what price is this a good buy for you? Of course, you can enjoy my video on Warren Buffett's mindset related to Coca-Cola. It's a great learning story. Dow, the chemical company, very interesting story here for investment bankers. First, they want to Dow, DuPont, merge them all, and then they want to, again, merge them all. So no matter what happens, the investment banks make the fees. That's how investment banking works. Nevertheless, the dividend yield is good for this cyclical company. Forward price-earnings ratio is lower because the cycle is always expected there. No expected growth. It is high competition, not really moats, but declining revenues we have seen, divestitures, shares numbers stable, so the returns come in form of dividends, and that is also what I used for my valuation here. So 280 dividend, growth of 5% of the dividend, terminal multiple, intrinsic value of 55, best case scenario 73. If we compare here, we are now in the middle between the conservative and the best case scenario. So this is a cyclical. You can always expect cyclicality here, since it was trading alone, since they DuPont and everything separation. You can see how it goes up and down, very down in bad times. So you just have to learn about the company and then hit it when it is, let's say, much lower in these crazy cycles that are really normal for these companies. It is incredible how cyclical these things are. So if you fancy these cycles, this is something to watch, as the market hasn't yet started following this company clearly, as it is just separated from its companions there. Goldman, very followed stock, especially here on YouTube, but it is a financial, it is a bank, and when things are good, then the numbers look stellar, but banking, when things look bad, then all the numbers that looked great disappear in a moment and everything looks very, very bad. So bad that they are happy to get a call from Buffett. Do you need $5 billion for convertible bonds? They say yes, at 9%. That was just 7-8 years ago. Now the story is completely different. The price-earnings ratio is just 8.44, the dividend is 1.44, and that's very interesting because now things are really good, but you have to expect bad times for these companies too. And you can see here the cyclicality almost went bust in 2008, then very bad in 2015, and now, just now, with all the money printing, now it explodes, and really exploded since October. This is insane of what's going on. I have made a conservative valuation based on dividends, and my price is half of what it is now, but we have seen on the chart it wasn't such a crazy price, as it was much lower just a year ago and 2 years ago. So it is possible that it will come again to these prices. I don't expect Goldilocks times forever. And you can see here the volatility, good revenues, then declines, then up, then hugely up now, but it will likely again decline, so no growth expected there. Growth in dividends, yes, so I have put that into the valuation, and they are doing staggering buybacks until bad times come, when they will be forced to slow down those buybacks and perhaps even issue shares. You never know. Interesting, complex business to understand. All the derivative plays, all the exposures there, leveraged exposure. As they are allowed to do more leverage, stocks explode, but that can also backfire. Too complex. These financial banks, insurance companies are too complex for me, so I don't really touch them, but let's put it here as we already have done the whole Dow Jones. Comparatively, amongst the most expensive stocks of the Dow Jones. Home Depot, great company without a doubt. I think return on invested capital has been staggering over the last years. Amazing scale. Difficult for competitors to chip away the scale and the pricing power it has. Good dividend yield, good price-earnings ratio, good cash flows, good dividend payout, so plenty of room there for growth. However, not that much expected growth over the long term. There have been some benefits now. The company is still growing, but we can see here the dividend is growing, the revenue not expected to grow, so we have to take that into account and see how it's going to continue over the long term. Something very interesting here. In 2015, Buffett's letter discussed mergers and acquisitions and spin-offs, and Home Depot, as we discussed with Dow, they have spun off in 2007-8 Home Depot Supply, and they just bought it back recently. So what Buffett says, it's mental flexibility of this sort by the banking fraternity, Goldman, that we just discussed, so has prompted the saying that fees too often lead to transactions rather than transactions leading to fees. So be very careful with these investment bankers. Their interests are always fees, not your benefits. So Home Depot selling something and then buying it back at a higher price and with big fees for others. However, from a valuation perspective, we said there is plenty of room for dividend growth. 10% dividend growth I have put here, 5% later, conservative terminal multiple, and the stock price 186. 267 with less conservative, 3% dividend yield, low interest rates, forever environment. And you can see here that it was, let's say, fairly priced for an exuberant valuation, but now it is even higher. So we can say that it is really richly priced now. Of course, it can be much lower if there is pessimism, higher interest rates, slower economic activity. So you might want to wait for it somewhere else, even if it did amazingly well over the last 10 years. So this is really remarkable. And if we check the numbers They have done great buybacks. They have really quadrupled net income, tripled net income, and therefore the stock also followed, plus the exuberance that comes along. And the main factor here is return on invested capital constantly around 30%, which is something staggering, and amazing management in this case. But now, perhaps even for the really good, a little bit expensively priced. Another stock that has exploded recently, especially over the last 10 years, Honeywell. If we check the numbers, low dividend yield, high price earnings ratio, so not much there to say. If we look at the growth, non-existent, so really another exuberantly priced stock, but the dividend is growing 10%, and there is still plenty of room for this dividend to grow at 10%. If we go for the valuation, I have put 8% growth next, then slowing down to 5, 94 stock price. Of course, when compared to the valuation of Honeywell, so really exuberantly priced. Intel, very interesting semiconductor company, now has a new CEO. I have made a few videos on Intel, so you will have them. The deep analysis, half-an-hour Intel analysis, and the update. And now I have to do an update. I'll do it likely for my research platform, just so no video, I'm sorry. But very interesting company. Sentiment is the key driver there. Now they have lost a little bit of market share, so the stock is going down. Then we'll have a new story next, and it will be very volatile, but the core fundamentals are there, still interesting. The dividend yield is good, the price earnings ratio is low compared to other companies, so, and they have high cash flows that they are using also for their buybacks. You can see the number of shares is going down as they're buying back. Revenue with stable periods, then it has ups, then it has downs, but it has going down, and they are making 20 billion of cash per year, which is what is making it a value investment, and why also Seth Klarman has bought. From a valuation perspective, this is market cap with conservative cash flows, expecting them to decline first, then grow, with a low terminal multiple on those cash flows used for dividends and buybacks. We get to an intrinsic value of around 235 billion. If I compare that to the market cap, it is, let's say, fairly valued now for a 10% return. Of course, it is really volatile. It has been very volatile. So you might want to play these ups and downs on exuberance, but we'll see the trend, the underlying trend for chips is extremely positive. So even by not being the leader, I think it will do really well over the next 5-10 years. I'm following, I'm learning, and we'll see how it goes. For now, we are nicely up here, so that's again a margin of safety. Now, IBM, another, let's call it value investment that didn't do well over the last decade, so very interesting proposition there. High dividend yield, low price earnings ratio, but also zero growth, actually declining revenues, and investors are not that happy with the management. There are also 2 videos that I made for IBM, so those will be in the links in the description below. We can see declining revenues, however dividends, they kept paying out those dividends, albeit the growth is slowing down a little bit. The cash flows are stable, so they have to deal with that. From a valuation perspective, IBM here, you see, I have put 5% dividend growth in the future, terminal multiple of 20, intrinsic value of 128. Undervalued if they can grow the dividend at 7%, which is also possible, especially if they do some miracles in the future, but still terminal multiple a little bit exuberant at 30, given that it is now at 20 and almost at 5% dividend yields. But on our table, let's say IBM is one of the cheapest stocks of the Dow, no matter the bad situation. So you have to see how this company now fits you. The sentiment is definitely negative. J&J, another, let's say, pharma stock, again on the cheapest side with the price-earnings ratio, not that much with the dividend, but still interesting. I have put 6% dividend yield going forward, terminal multiple 25, so 4% dividend expected, and my intrinsic value is 97, 120 max. If I compare that to the stock price, it is overvalued for a 10% return, however, not far from a possible 6-7% return if we compare things. Of course, compounder over the long term, good company, good market position. So very interesting for those who are interested in such a business. However, here on the table, among the most expensive but still good business, 5-6% return long term, which is in line what all indices are giving. JP Morgan, another financial, normal dividend yield, very low price-earnings ratio. However, keep in mind the financial cycle there. I have made a valuation based on the dividends with 10% dividend growth ahead. Despite the financial cycles, let's say that they can keep paying out these dividends, and I get to a fair price, which is, in an exuberant case with 15% dividend growth, not that overpriced for a 10% dividend yield. Of course, you have to see how this fits you, and it was much cheaper here. As said, I'm not a specialist of banking, but banks are and have been relatively cheap compared to other companies, and still are. But keep in mind the risks, and this can look really ugly when things look bad and are bad, because all the leverage that can backfire, especially all the leverage that is in the system now. Stable revenues there, so a little bit better when things are exuberant. Dividends have been growing significantly. That's also why the dividend growth in my model is much higher compared to others among the cheapest stocks of the Dow. McDonald's, 2% dividend yield, forward price-earnings ratio among the highest there. McDonald's is McDonald's. There's still expected some growth there, but 4% dividend, likely growth of 6% I have put in my model. $107 is the intrinsic value for a 10% conservative return. If we look at the stock price, then it's extremely overvalued, and it has really exploded from, let's say, a 10% return. So we might call it exuberant, but its position in the market is strong, and that's why it is exuberant. Also, stagnating, declining revenue growth, but they are doing buybacks, so we can call it a cash cow, higher dividends per share, so that might lead to better valuations. However, focus on valuation and trends if you are following this. Merck, a company that we discussed recently as Warren Buffett bought. Pharma is cheap. We see the forward price-earnings ratio being low. The dividend yield is relatively higher, 3.34%. I have put a 5% dividend growth ahead in my model. You also have here the discussion of the comparison of Warren Buffett stories. So 2.6 dividend, 8% dividend growth, value 63, 85 possible value, and you can see here how the stock price is there for a 7 to 10%, even higher return if things in the pharma situation remain stable. Of course, you have to expect huge ups and downs depending on how they develop those drugs, the sentiment there, etc. But the trend is unfortunately positive health-wise perspective for us for those pharma stocks. Microsoft, low dividend yield, high price-earnings ratio. However, it is more of a growth stock with expected 10% growth. So revenue is still growing really good. So 10% growth there. The cash flows are also growing now at 50 billion in cash flows, which is really crazy. Dividend is going up, and of course they are now focusing on buybacks to lower the number of shares outstanding, which is, let's say, a risky play. However, 50 billion in cash flows compared to the market cap of 2 trillion, that's a price to cash flow ratio of 40, but of course if they keep growing at 10–15%, however, at some point you have to keep in mind that limitation. At some point they are not going to be able to make 200 billion, so will this be able to quadruple to lead to a 10% return? I don't know, and that's my concern. How big can these cash flows be? How big is the potential for these companies? That's my concern when it comes to companies like Microsoft, so exuberantly priced, which leads into, let's say, low return expectations in my perspective. Similarly, Nike is again a company with very low returns ahead from my perspective, low dividend yield, low cash flows, high price earnings ratio. Everything is expected on growth that's actually not there. And I have made an analysis how Nike is a good company, but Adidas is better. However, Nike might grow faster because of the financial engineering there. And if we look at Nike, revenue has been stagnating already for years. They have been pushing the dividend higher. They have been doing some buybacks, but it's really crazy how this can be valued at such an exuberant point. I have made a valuation, and you see that dividends, even if they grow at 10% and terminal multiple is just 3% down the road, because dividends is what gives you the returns, the intrinsic value is just 41. If you compare 41 with 130, then it's really extremely overvalued. P&G, great business, great brands, so really known company, 2.6% dividend, stable price earnings ratio, so in line with the market. Let's see the valuation. So dividend yield, 5% growth, I said 25% multiple, 71 the valuation, 72 the stock price. Okay, fairly priced, exuberantly priced for such a return, but it was priced much lower just a while ago. And all these companies usually come into bad times, and then when revenue isn't growing, competition, then they manage to get themselves out. So it is perhaps better to wait for those bad times. On the valuation here, among the most expensive, not expensive as Nike, but let's say one of the most expensive there. Slow growth, now they are getting back to growth, back from bad times here when the stock price was also much lower. Earnings going up again, but not really spectacular. However, the dividend is going up, so they are rewarding shareholders there. Salesforce, a growth stock, expected growth in revenue ahead 20%, so all the valuations are really sky high from that perspective. So we have to value it also differently. And I have used just earnings with a 25 PE ratio 10 years down the road, and if they keep growing at 20% and 10% from 2026 to 2031, don't watch these numbers as I haven't updated the years, but in year 10, then the intrinsic value is 160. If they grow at 25%, then the intrinsic value is 400 with a higher terminal multiple. If I compare that to the price, there is plenty of room to reach the 400, but also the 160 have been there just a while ago. So it is not an exuberantly priced growth stock in the Dow Jones. And they are really growing at staggering rates. However, I always wonder, yes, 20 billion, it's much easier to grow from 2 to 20 than from 20 to 100. So that's also something to keep in mind, is the size, as we discussed for Microsoft. Nevertheless, the price-earnings ratio is higher, but watch the growth and also watch the investing environment. Travelers, going more again into the insurance, and those are always cheap. There is now interest rates. If interest rates go higher, that's a positive. If not, that's an still negative, but if inflation hits, that's a negative because you collect your premiums now and then you have to pay the claims later at a higher cost. Nevertheless, stable revenues, they're highly growing, or stable earnings, a little bit volatile, however amazing, staggering buybacks that they have been focused on. With those buybacks, of course, the stock price did really well, so that is also good for them. I have made a quick valuation, but my valuation doesn't hit those stock prices by far. Similarly, United Health, low dividend, a little bit higher forward price earnings ratio, great company, they are still growing there in the medical sector, medical insurance, private insurance, earnings per share, staggering growth there, dividends growing. I have put 15% dividend growth rate here with a 3.3% expected yield in 10 years. Then the intrinsic value is 258 with a high of 400 in really exuberant valuations. If we look at this, then we are at 400, so for the most exuberant valuation. But you can see here that it was fairly priced just a while ago for a 10, even higher return for those that were following. So we keep it here on our comparative table, and then when it is again fairly priced, we might take another look. Verizon, discussed that in a video. Check that video specifically dedicated to Verizon, Warren Buffett buy, and also a cheap Dow Jones stock. High dividend yield, so a real dividend stock, and I expect a little bit more dividend growth there. So dividends 5% growth, and then when the 5G capex subdues, I expect more growth. So if we calculate that with the 5% expected future dividend yield, the intrinsic value is 57. It can be even higher if the market's sentiment changes. So 70, 57, and here we are, 57 for a 10% likely long-term return. Of course, it's a boring stock, so nothing stellar, but slow and steady compounding, good cash flows, good dividends, and that's also why it is likely that Warren Buffett bought. Don't forget to check my Verizon video. Visa is a growth stock, really richly priced and risky in my perspective. Dividend yield is very low, the price earnings ratio is extremely high, and I have discussed Visa a year ago in the Delta of the Delta tool for growth stocks, where you look at the change in valuation depending on the expected growth. And Visa is growing, but not that much anymore. However, they are improving net income, and now as COVID subdues, it is expected that they will grow further. And I have taken the earnings here to make a valuation with the 25% dividend payout for the present value calculation, 15% growth rate for earnings estimated here. With a higher dividend yield, I'm still at 160 to 223 for a stock price with a 3% dividend yield expected in the future. And that's half of the current price, and Visa has been just exploding. The question is for how long it will be able to just keep on doing what's doing. So it's a pure growth stock in my perspective. But if you follow it, if you know it, you never know when you can find these great opportunities, even to buy a growth stock at a discount. Walgreens, higher dividend, low price earnings ratio, so again cheap from that perspective. However, let's say a slow growth company, slow dividend growth, but they are doing significant buybacks over the last years, good cash flows, declining a little bit, so that might be an issue. From a valuation perspective, I have put 7% dividend growth, terminal multiple conservative of 5% or 20, and then we are at 42 with a 4% dividend yield. We are at 60, and you can see that the price is in between 42 and 60, so likely good returns here, and perhaps even the stock price might continue and return to the previous highs. So there is a margin of safety, stable, company. There are competitors now, there are some issues in the sector, and you have to watch and follow how will the company react to these issues and situations in the sector. Walmart forward price earnings ratio, as it is omni-channeling, has gone up, the dividend has gone down, and the company is really growing slowly and steadily. It's increasing its dividend, working on the cash flows, nothing wrong there. I have put 5% dividend yield going forward, 4% expected dividend, and my price is 50, 67, 50, which is far from this price, so extremely overvalued from fundamental investing perspective. But this is investing, this is, let's say, valuations. Now it is hot. 5 years ago, when I first looked at it, it wasn't hot. So it's interesting how these businesses change. Alright, so the last one, Disney, did really good lately, especially after the COVID crisis, was in a bad situation, but now it turned from what it was, an entertainment stock, into a streaming stock, and those stocks have been really cool lately, especially since November. And that's exactly the thesis I discussed in a video a year ago, that if Disney is priced at least like Netflix, then it's worth at least double. And that is exactly what happened recently, but for me it was a little bit too much risk, so I always considered it a medium risk, high reward analysis. If we take a look at the valuation, I have taken the dividend, I have put 10% growth ahead as the cash flows from the streaming come in, 15% later as it gets bigger and bigger, terminal multiple of 25, so for a 4% dividend yield, and I get to a valuation of 75, more exuberant 107, with a 3.3% dividend yield, and then with a disaster situation really low. So my price is far from the current stock price, which means it is, for me, a little bit risky. So you have the template, you can download it in the links in the description below. It's free there, you can play around, you can change the things, you can change the numbers. For now, in general, there are some good buys, something to follow on a relative perspective, and you have to see how this fits your portfolio, how those businesses fit your portfolio. There are some really exuberant, let's say risky or richly priced, that might be better to avoid buying or adding. So I hope you have received value from this video. It was a really nice exercise for me to do. I really enjoyed it. So thank you for watching, and I'll see you in the next video. I might do something else, something completely different, because that's what I like doing, and that is looking at businesses.